welcome.
Yeah, we're back, baby.
Ready to talk some nonsense?
Yeah, who are we? We have to say what we do.
I am a financial planner.
I'm a financial advisor.
We'll talk about the difference another time.
Yeah, absolutely. We're back. After a weekend, we had Canada Day this weekend. In the middle.
Happy Canada Day.
In the middle of last week, I guess.
Yeah, you could have said a couple days ago.
Couple days ago, yeah. A holiday in the middle of the week kind of stinks.
Yeah, because I still worked. I don't know about you.
Yeah, that too. And people are just going back to work for 2 days after everybody's checked out, combined with summer.
Yeah.
And everybody's got the World Cup fever, so people are just in office watching the games anyways.
Well, 100%. Plus, it just pushes everyone to take Friday off instead. So why don't we just do it on the Friday?
Oh, yeah. During the summer, if you work in any sort of corporate landscape and you try to get somebody, and send an email or call somebody on a Friday, there's a good chance they are out of office.
That's why we have AI tools now.
Yeah. What do you use the AI for? What do you mean? To answer?
An AI assistant, just to answer all your emails on Friday. Make it look like you're there. Hey, sorry, really busy today. Get back to you Monday.
Yeah, no to all. Do not contact me. What's the weekend? It's Monday. It's Monday morning. The weekend was good for you. Soccer heavy. Football heavy.
Weekend was good. I'm freaking really tired right now. My kids were up all night, but we battled through. That's being a parent.
Yeah. I'm tired because I was up all night. Yeah.
That's being a child.
I actually got, I don't need to tell you, I'm not a big soccer guy, but I've been invested in these games.
Yeah, you were still messaging me last night.
Viva Mexico. I know. It does get exciting when there's a lot on the line.
Yeah.
And
these games now, like the round of 16 and into the quarters, is exciting.
Yeah, the controversy involved in soccer is nuts, and you see since when can you just go back and review a penalty kick? Has that always been the case?
Well, since VAR now. Honestly, it's been okay for penalties because you actually get to see the guy get kicked in the leg. The president calling the head of FIFA to get a red card overturned, that is some that's some insider stuff right
Donald
there.
Trump.
That's pretty crazy.
Donald Trump doing
it's almost
Donald
like
Trump.
FIFA's kind of, offside in most cases.
Yeah. I know that's insane that they would do that. You know how many times in every other sport you have a bad call and you just be like, "Hey, I had a bad call," but they're bending over backwards. I'm sure he's.
Sure, it's. There's that C word, corruption, that's always involved when Go Argentina is
I know
what the FIFA say.
I only watch soccer once every 4 years, and it's good to know it's just corrupt as hell. Kind of like it that way. Interesting. Soccer's interesting. Speaking of interest, we are talking about interest rates. It seems that we hear interest rates take up a big part of the news. We're always talking about interest rates. It's become common. Like growing up, obviously we never really talked about interest rates, but I seem like it's on par with talking about the weather now.
Oh, 100%. Interest goes up, everyone's sad. Interest goes down, everyone's happy. It's like the sun coming up and going down.
Yeah, I mean, it's good that people are talking about it and they understand what interest rates are. Obviously, interest rates, there's a variety of different things it pertains to. But when we're talking about interest rates, obviously we're talking about the cost to borrow money.
Yeah.
In this world, you can have all the money in the world, but you're only as good as the amount of money somebody's willing to lend you, right?
And if they won't lend you money, it's tough.
Somebody will.
Yeah.
And get in bed with the wrong people. Up
in Woodbridge. And
yeah. I got some cousins, I think, that'll lend you some money. Yeah. 30 points. The juice is flowing. But yeah, in this day and age, you want to buy a house, you have to borrow the money to do so. You want a car, you got to borrow the money to do so.
Yeah.
Everything seems to be interest based, and obviously when you borrow that money, the interest rate is the amount you're paying to borrow that money, and that interest rate fluctuates based on
a ton of factors. if you want to talk more recent, so it makes a little bit more sense for right now, interest rates are highly based on inflation. So right now, let's go back to 2020 until now. Everyone remember in 2022 when interest rates skyrocketed in 3 months and everyone was panicked and everyone with a variable mortgage was like, I'm going to have to sell my house. This is outrageous. That had to do with inflation getting out of control. So the government, and for us, the Bank of Canada, and the US, the Fed, they have to increase interest rates so that we can bring costs of goods down. That could be oil, that could be food, that could be anything you can think about. But what it does is it affects your home, your ability to buy a home, your ability to qualify to buy a home. If you own a car, it affects that payment. It's a rippling effect all the way down, and you could spiral into a lot of negative thoughts. So it's something you have to plan for and you have to understand.
So to break it down for like the common man, you know, some people are always, oh, what's prime? What's prime? What's prime? Brett, what's prime?
Prime is the regular interest rate that the Bank of Canada sets. So prime right now is...
The prime rate in Canada sits at 4.45%.
Yeah. So that realistically will probably stay there for a little while. What we don't want to see is inflation keep going. Unfortunately, it is on the rise again, and that has to do with everything that's happened in Iran and now that's happening through negotiations at Qatar, and that's a whole other hour episode to talk about.
Yeah.
But
the interest is currently not ideal.
Yeah, if you look at history, interest rates are still pretty low right now.
Okay.
But if you look at the last 10 years, yeah, we're getting kind of mid to high. When you go to get a mortgage or a line of credit or anything from a bank, you don't get to pay prime. Yeah. It's really nice to say, okay, 4.45, 4.75, whatever it is, I get to pay that. No, you have to add probably a point to it.
Yeah, so prime essentially serves as the baseline for all lending.
Yeah.
So 4.45% is the baseline, and then lenders, so whoever you're borrowing money from, whether it's for a mortgage, car, whatever we were just saying, they add a percentage point or 2 or 3, whatever it may be, to that, and that's their way of the lender making money.
Yeah, it is. And for anyone listening and watching this, it is as confusing to us as it would be to you when the Bank of Canada increases the prime rate. So let's say the Bank of Canada tomorrow increases to 5%.
Okay, so that means I borrow $100,000 based on prime. I am paying 5%.
Yeah, if you're only paying prime,
if it was just prime, $5,000.
Now, what's ironic about it is it's not that the bank turns around and pays the Bank of Canada the difference. So we just had all of our 5 large banks have the biggest profits they've ever had.
Yeah.
They all grew over 30% each.
Okay.
And a lot of it, especially companies like TD, a lot of it ended up being lending. So these companies have been able to make a ton of money off lending.
Yes.
So that is why you, as a retail investor, as a client going into the bank, someone that's looking to get a loan, you need to understand interest rates. You need to understand how they work, because you should understand where your money goes, because it doesn't go back to you in any way. It goes to the profit maker that has given you that money.
Somebody's making money.
Always.
So we have 5 big banks in Canada. So when it comes to getting a mortgage, obviously, one of the big talking points, mortgage, we'll just use a mortgage because that's one of the biggest things we go through. You know, what's the interest rate? What's your mortgage? What's the interest rate on your mortgage? That's one of the number one questions we ask clients. That's the number one question most people ask when they're like, oh, you bought a house. What do you, blah, 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 blah. There's different terms, variable, fixed, all that fun stuff. Now it is one of the hurdles that we have in Canada is it's relatively hard to get a mortgage.
Yeah, let's get more specific. Say GTA.
Can be GTA. And when I say difficult, we just say the legwork to actually get a mortgage. You know, you should have X amount of income, right? Your credit score is a big thing. We also look at something called TDSR, which we will talk about.
Total debt service ratio.
Total debt service ratio. That's a big part. We'll talk about that in a bit. But going through and getting that mortgage. So again, 5 major banks?
5 major banks. Obviously, we also have credit unions, et cetera, but 5 major banks that would be considered tier 1 lenders.
So let's see how many banks there are in the U.S.
Oh, you can look at per state in comparison to Canada.
I believe there's so there are approximately 4,462 FDIC insured banks operating in the United States. This number includes around 3,900 commercial banks and 554 savings and loan associations. So obviously,
I wonder why 2008 happened.
Yes. So in Canada, obviously harder to get a mortgage, but somewhat for good reason, would you say?
Yeah. Even right now, the U.S. is actually going through a little bit of a financial crunch when it comes to lending. They've lent out too much to people with too little, I'd say.
Yeah.
Canada, you're just not really allowed to do it. There's a specific percentage of your TDSR, which we'll look at in a bit, that you have to have. I will say mortgage brokers can get creative, but you can't go too far above the line.
Yeah, of course. And we live in a situation like when we go to get a mortgage, if you go and say, hey, I have a $200,000 down payment, they're going to say, okay, well, it says here your salary is $60,000. Okay, where did you get that $200,000? Many times it's a gift. Oh, it was a wedding gift, or it's from my parents. They're like, okay, we need to see proof of that. Yeah. So now you have to get all the documentation and back it all up.
We have a regulatory body called FinTrack. Banks, lenders, you can't just come with a bag of cash. They're going to ask where this came from.
But in the United States, they don't necessarily have those same parameters. So you can be like, hey, I've got a bag full of money, and one of those 4,400 banks is going to say, ooh, that's money. That's real money. I want that money. And they're going to take it, right? Yeah. So there's the stipulations. 10%. And now the problem that lies with that is you're going to start giving out, you're going to give out those loans. You're going to take that money because money is money at the end of the day. I trust where you got it. Guy comes in a Rolls Royce bouncing or something. I don't know. Some gangbanger shows up. Yeah, I'm not going to turn away money. But then you leave yourself open to to essentially what happened in 2008. You're lending money.
People stop paying their debt obligations
too graciously. So people
called defaulting.
Yeah. So in Canada, essentially, the process to get a mortgage is difficult because we run the risk. Anybody runs the risk of defaulting on a mortgage, right? Your situation can change. Bankruptcy comes into play, all these different things. But at least by making it more difficult and making it a more arduous process to go through to get that money, obviously we're going to see less defaults because more people are protected, which is a good thing.
It is a good thing, yes. It doesn't mean that life or your pocket gets any easier. Mm-hmm. You just have to switch things around.
Yes, and we're seeing, so in terms of defaults on mortgages.
In Canada, extremely low.
Extremely low.
Extremely low. And the ironic part is in the last 6 months, we've had now a steady increased interest rate for probably the last year and a half now. And everyone it seems is up for renewal of their mortgage now. Everyone's at 1.99 on a variable rate from 2002, and they're all re-upping right now. So people are panicked because a $5,000 payment's now an $8,000 payment when it renews at 5%. Now you would think in a situation like that okay, I can't do this anymore. I'm going to have to sell my house, or I'm going to have to default on my loan, or I'm going to have to figure out where to get some money to put down. In Canada, ironically, because of how lower interest rates were for so long, what people ended up doing is they're spending their money on other things. So and this sounds crazy, but boats, Sea-Doos, motorcycles, watches, everyone was spreading their money thin. Just because interest rates were low doesn't mean that people were ready to spend less. It just went to other places. So instead of defaulting on their mortgage, everyone now is defaulting on the extra mentionables.
So we have can you pull that up, that slide I sent you? Yeah, because if you're in a position where I can borrow money for cheaper, you're saying I can get a cottage?
Yeah,
I can get a boat. You're gonna spot me money at 1.99%. Yeah, of course.
Do you realize how cheap 1.99% is?
Yeah.
So this slide's really good. So This is a subprime lender called Go Easy. So one of the biggest things they lend on are boats and Sea-Doos, that kind of stuff. Now, January 2026 into February, we had an increase of our prime rate, and it was extended along this time. Look what happened to Go Easy's stock. We're looking at this line right here. That's not a good line when you're buying stock, right?
Straight down, baby.
Straight down. And what that shows us is that companies like this are suffering. Our banks are not suffering because mortgages aren't being defaulted on, and a bank's not going to give you a loan on a boat when you already have a mortgage, when you have certain other expenses. It's just not going to happen. But Go Easy will give you that money anytime.
Of course. And I think when somebody buys a Sea-Doo and then they just stop making the payments, they're like, what are you going to do? Come repo my Sea-Doo? Come take it. I don't need it.
Well, that's what people are doing now is they go, I can't afford, like their payments went from $1,000 to $3,000 a month just for their Sea-Doo. They're like, it's cheaper for you to come get it
come
than it
get
is
it.
for me to figure this out.
Come get it on the water.
Yeah.
I'm going to be out there. Yeah, come get it.
I'm thinking of what's the show, Kenny
Powers?
Kenny Powers.
Yeah, eastbound and down. Yeah, you want the Sea-Doo, you come get it. But yeah, it makes sense. You know, people, but you put the opportunity to borrow money for cheap. It's more enticing to do the things you want to do. Even how does through my understanding with credit cards is the kind of the one exception, because credit cards are such a high interest rate anyways.
Yep.
When interest fluctuates, people are always like, oh, interest rates are going up, my credit card. Now, albeit you don't want an exuberant amount of debt, but because you're already used to a 22% interest rate on credit cards,
yeah,
that doesn't necessarily impact that spending. So it's more direct, being lent money with purpose. So
100%.
Yeah.
Well, because credit cards as well, your goal with the credit card is whatever you put on it, you're paying it off that much.
Yeah, right?
That's your goal.
Yeah. That's
Gav.
what we do. Yeah.
Because you don't have to pay interest rate if you pay it within the month.
Course.
And if you have to pay 1 or 2 months of interest rate, that's not the same as having long-term debt where you're paying for, when you're buying a Sea-Doo and they amortize it over 15 years, there's something wrong there, guys. That's a lot of money these guys are making at 10%.
Well, but that's just people trying to capitalize on opportunity, right? You can finance everything. You can go on, pick a product, any product. I'm pretty sure you can finance concert tickets now. People are going to Coachella and they're paying $30 for the next 7 years.
Are you talking about like these buy now, pay later type?
A-Firm is a good one. Yeah. A-Firm's a good one. Yeah, a lot of them.
Yeah, but
like you go get the brand new.
They're crashing right now, right?
Most of them are crashing unless they get backed. Like A-Firm, Apple signed a strategic deal with them, so things like that work. But it's, as Gavin's point, you go out every year and you get the new phone because you could finance it over 4 years. So you're actually paying a mortgage on your phones forever.
Of course, but that dopamine hit right now. I want to go to Coachella VIP experience with my friends.
Yeah.
I can't afford it, but what I can't afford is $14 a month for the next 10 years.
Yeah.
Turn up. That's a tomorrow problem.
I knew it was getting bad when my wife and I moved into a new home 2 years ago, and I'm a big hot tub guy. I like to just chill at night after putting the girls down, and they're like, you can amortize this over 20 years. Your payment would be $50 a month. I'm like, what?
Oh my God.
What? And they're like, yeah, everyone's doing it.
Babe, we paid off the hot tub. We finally paid off the hot tub. That's
By the
insane.
time you pay it off, that hot tub's broken, man.
Oh my God. But it's that's been around for, like, Leon's don't pay a cent event. Buy a couch and you don't pay for 3 years, no interest.
Yeah.
And then all of a sudden somebody spent $27,000 on a couch in interest.
Yeah, my sister actually bought her first couch on interest.
Yeah.
And then realized what happened, just paid it off immediately.
Financing a couch. I mean, I get it.
Times are tough,
Couches are
guys.
expensive. Yeah, but I mean, if you can, if you want that couch, that's a way to do it. Of course, absolutely. But so interest rates vary. So back to kind of the interest rate conversation of the interest rate prime can move at any given time.
Yeah. So if we're thinking about a mortgage, there's variable, and there's fixed.
Yes.
So why don't you chat about variable, because that's kind of what you're getting at.
Yeah, so essentially, when you get a mortgage, it can be fixed for X amount, for whatever term it is. Let's call it 3 years fixed at 5%. That means that regardless of what prime does, your interest rate is fixed at that rate. Variable can change. So your 3-year variable, it could be low now, but if interest hikes, then your payment will hike. Next month's payment could be totally different than this month's.
Yeah.
And that's what we saw quite a few people in 2022.
Yeah.
You get a variable rate. I think interest rates will go up a little bit, so I'm going to borrow the money for cheap now. And then lo and behold, a year later, interest rates skyrocket. Did your income go up that much? Probably not. You saw upwards of 3%. Did your income go up that much? Can you afford that?
People aren't paying cost of living adjustments of 5% anymore. It's crazy.
Yeah. and it seems in the moment, this was your opportunity. This might be the first time you have a chance to buy a house. Let's do it. And you have every real estate, everybody, especially in the GTA, it's like there's never a bad time to buy. Never a bad time to buy. And get in the market.
And once you see the house you love, it is very hard to say, it's just over my budget. Let's go to the next house. No, you go make an offer, put 40,000 over. I want it tomorrow.
Yeah, or they get it, or you trick yourself into being like, oh, we got into the market, and then you see the house and it's a dump, and they're like, oh, it's a fixer upper, and you're like, yeah, it's a fixer upper. How much is it going to cost to fix her up? Couple $100,000. You have that? Probably not.
Yeah, but you can get a home equity line of credit with more interest.
Hey, borrow. But also I think that when it comes to first-time home buyers, we've seen now more than ever people, you see this, for lack of better words, dog shit house, and you can afford it. It's a house that you can afford because, again, it comes down to it's very hard to get a mortgage. Yeah. And you find this house, and people are kind of like convincing themselves. They make accommodations, it's how people will date they're in their 40s, they're single, they meet somebody, and they make that compromise. Like, you know what? Sure, this guy's a drunk, and yeah, he hit me once,
sometimes.
But that's how people are treating houses. They're like, sure, it's beside a train track, and I'll never sleep once, and air conditioning doesn't work, but we can fix that. I found it, babe. I want this house. This is the one I want. It's desperation.
Look at the kitchen.
It's desperation. And this is also coming from a man who's approaching 40, living in his parents' basement. But even having said that...
That's why this is gross domestic nonsense.
Yeah, I know. But it is that interest entices people when the interest rate is low, and being able to borrow money for cheap, it entices you to make purchases you wouldn't otherwise do, right?
Well, when I bought my first house in 2014.
This guy sound like a boomer over here. When I bought my house back in the...
And I walked uphill both ways in the snow to get there.
1971, I bought it in cash for $80,000. Yeah, now it's worth $4.5 million, and I still won't sell it.
That's the boomer way.
Yeah.
I bought my first house for $365,200. Back then, that was what I could get approved for, and it seemed outrageous at a $1,400 a month mortgage payment. You look back at that, that's just interest now on a mortgage payment.
Of course.
But I couldn't imagine going to the next house for $500,000 or $600,000 and spreading myself thinner. What's happening now is there is no $300,000 houses. There are no $500,000 houses. There's some $800,000 fixer-uppers that'll...
Houses,
yeah.
But they're mostly like $500,000 to $700,000 condos.
Yeah, condos. Yeah,
condos. Yeah, you're getting 600 square foot for $700,000.
Yeah, and even buying a condo, it's a great way to live or whatnot, but it still needs to be that kind of longer term. You're not flipping a condo in a couple years, and I think that's one of the reasons.
But that's the problem is condos are I'm not going to lie, they're kind of meant to move more often.
Yeah.
Like condo market is healthy when people are moving in and out.
Yeah, people will buy, homeowners will use the equity in their home to buy a condo and then rent it out to somebody.
That 2020 shit.
Yeah, I know. Everybody bought a condo to rent out, and then interest rates went up, and all of a sudden the rent they're charging didn't cover the mortgage
And then
payment.
Increased the rent, and then rental control came in.
Yeah,
and it was the whole thing.
And then in Ontario, you don't even have to pay your rent.
No,
right?
you can just squat. No
Again,
problem.
It's the Sea-Doo all over. Oh, you're kicking me out? Come kick me out.
Yeah, you got to come in the house first.
Yeah, they're like, I'm going to sue you. You're like, well, I don't have any money anyways. So what are you going to sue me for? I'm going to live here. I'm going to squat. Yeah.
Puts on the Xbox headphones, gets back into it.
Yeah. Yeah, hey, sorry, fellas. Where are we dropping? Oh, you all good? Yeah, no, somebody just tried to kick me out of my house that I don't pay the rent at. Yeah,
Again?
Yeah. So interest, it's part of life. Where do you foresee? And again, there's so many factors. We want to see in the ideal world interest rates drop. That's good for everybody in terms of what you're paying.
Drop, but not plummet.
Yes.
So you don't want to see interest rates drop, say, 2% or anything like that. That would mean we're in a really bad economy. That means times are really, really tough. So if you think of 2020 when COVID hit, obviously none of us saw that coming, and obviously our government was not prepared for that. So what
Our government saw it coming.
Yeah. Tinfoil hats. What the Bank of Canada did is they slammed interest rates down really fast in March and April, and that led to bond yields going crazy, led to the equity markets getting out of control. It put us in kind of to this equity tailspin for a long time,
of course,
which we're kind of just getting out of. And so that actually had a negative effect long term.
Yeah.
Seeing kind of 25 basis points cuts like we saw last year and the year before, that is healthy, and that puts the economy on a good standing. Mm-hmm. Thinking about what's going to happen this year, I think we would have had cuts if everything didn't happen overseas with the squeeze of oil and consumption. So I don't think cuts are coming anymore. What we don't want is increased inflation, because there's more of a possibility of another increase.
Gotcha.
So when you're going to look for a home right now, just remember, when the bank says, I have this special variable rate at 2.5, you should take it. Please do your math. What happens if it goes to 3.5?
Yeah. And then in terms of, now, a big part of our business is wealth management, investing. When we're looking at the markets, typically when interest rates are low, markets do well.
It's almost like people borrow money to invest.
Yes. But not only that, the companies that you're investing in also operate on borrowed money. So they have capital that's invested. They've borrowed money to invest in their company and grow, regardless of what company it is. So when their costs to operate and they're operating at a low interest rate, that means they have more money to use, pay employees, operation costs, you name it. When that interest rate goes up, now all of a sudden you're impacting the profitability and the revenue of the companies you're invested in. That's going to take a hit. So the numbers don't look as good. People get weary and they pull out, essentially. Well, that's what can happen. It doesn't always happen, but it's something to be very to just be aware of, because especially in the technology space, a lot of these startup companies, they're based on future valuations. What are you Dragon's Den? My company's going to be worth $30 million valuation. Yeah, but you have $200,000 in the bank. Yeah, but it's going to be worth that based on the way we're going and the money I've borrowed. So
VC lending.
VC venture capitalists, yes, if there are any out there. Yes, so it's just, again, it's a day-to-day. It can affect not only the amount you're paying for your own personal stuff, but your portfolio is going to be impacted by interest rates as well. So there's no escaping kind of like, oh, I don't have any debt or I haven't taken on a mortgage. Okay, well, if you're still investing, interest is a big factor when it comes to how the market fluctuates. Yep. The other thing we can talk about too, since we're talking about borrowing money, is your total debt service ratio.
What does the bank look at when you want to borrow money? Do you want to scroll down, Dante? Keep going down until it says total debt.
When I go to the bank and say, I need money.
Yeah, that's perfect. So when the bank is looking at you, there's obviously other factors too, but total debt service ratio is the biggest factor they look at. And what it is, and what you can see here, is you're adding up your total monthly expenses Here's your example: mortgage payment, taxes, school taxes, heating, electricity. If you have condo, 50% of condo fees. And then you divide it by your gross monthly income. And that gives you a percentage. The bank wants to see 40%. The bank will lend at 44%. The bank does not want to see 50. But does that mean you won't get a mortgage? No, it just means you moved from tier 1 banks to tier 2 to tier 3. And you kind of make your way down, which can get very dangerous.
Question, so we only have 5 banks. Which ones are the tier 1s and the tier 2s?
So our 5 major banks are tier 1s. So that's RBC, TD, CIBC, Scotia, National.
Yeah.
And then you would get into tier 2 lending after that, or credit unions like Meridian,
Okay.
B2B.
So
that kind of
it
stuff.
doesn't necessarily need to be one of the big banks that's the one lending you money. You still, we have 5 banks. We have plenty of other financial institutions, lenders. Duca Financial is a
Yeah.
lender. I'm trying to think of
Like
who-
a tier 2 for mortgages in Canada, First National would be a big one that people use.
yeah.
You're typically going to pay prime plus 2 or 3 instead of prime plus 1 as an example for lending. So again, when you're looking at interest, make sure you can actually afford it. Just because you get approved for it doesn't mean that you should necessarily go that route.
Yeah, there's plenty of ways to go. Obviously, you want those A lenders. You want to go with the best because not only can they probably offer you the best interest rate, but people do like to know that their money is with, it's like you got to earn that mortgage. You can't just be like, people are like, oh, who's your mortgage with? And you're like, this. And they're like, oh, it's not with RBC or BMO? You're pathetic. You didn't get one of the good guys to lend you money. What's that one jingle? Alpine Credits, where homeowners get approved. If you own your home, you get approved. You get approved. You get approved.
There's that American stuff again.
Yeah. So if I'm making $8,000 a month,
Yep.
and you're saying 50%, if 50% of that is already gone out the door for my obligations, so $4,000 is for bills thing and
Yep.
that, they don't like that. 50% of my money being already.
Yeah, well, they can just, it's basically a proof that you won't be able to afford it long term.
Gotcha.
And does this scenario have side effects that are incorrect as well? It does. So being someone who's incorporated and runs a business, I'm not going to pay myself an exorbitant amount just to get a mortgage, even though that's what lenders want you to do, because there's other factors. Now my tax rate goes up and my income comes down. It's a whole smorgasbord of issues. So it's not a perfect system. And it's why you have professionals you need to talk to about it, say a mortgage broker or a bank broker, to really talk you through it. But it is at least there to keep you a little bit more safe than otherwise.
Yeah, and when you're approaching this, like working alongside an advisor, guys like us, we do have access to, whatever your given situation is. It's a case by case scenario. Obviously, we're inclined to know how much you make, your debt. Your income and your debt is one of the first questions we ask because it shows us kind of where you stand.
Yep.
But again, if your income's lower and your debt's higher, there are scenarios that we can put together and work with other professionals that can get you the best bang for your buck, so to speak, or even just because a big bank won't look at you, even a B lender won't. There are other options available, but being able to know where you stand. The amount of times I'll talk to somebody and I kind of have some insight into what they do. And I'm like, they're like, oh, we just bought a house. And I'm like, how? You? How?
Yeah.
What?
That guy in high school who just
Oh,
stood under the bleachers all day.
Yeah, I know. Or yeah, just like the dumbest guy I know in high school owns just like a big
Got
home.
a
and you're like,
$1.5 million property.
yeah, and it's not, hey, but again, parents' basement, baby. That idiot owns a house. But there's something for everybody, and of course there is the scenarios where there are certain mortgage brokers that can look at a file and be like, in my experience,
Yeah.
no.
At the end of the day, you also cannot, just like investing, you can't be afraid to make moves when it comes to your debt. It's all a part of your financial planning.
Yep.
So we'll have clients all the time being like, yeah, my mortgage with Scotia as an example. Okay, great. Let's look at, that right now, like your price to get out of this is so cheap. if you go to RBC or an example, anyone else, you're actually going to pay less. And people go, no, I can't leave the bank. Like that's where I have my stuff. Don't be afraid to look around and to move around. Debt is debt. Whatever is the best price is what's the best thing for you. Don't worry about if it's a blue title or a red title or an orange title. It's whatever's best for you and your plan.
There's also one scenario that I run into a lot is people do have significant credit card debt. They do own their homes, right? So they do have that equity in their home. So essentially you want to borrow that money at a lower interest rate to pay off, to consolidate that credit card debt. Yep. Credit card interest way up here. You know, if you borrow money, you're paying at 6%. Let's borrow that to consolidate this. So there's ways to borrow. Yeah, refinancing to borrow, to pay off borrowed money in the wheels turns. But there are good strategies to actually save you money.
Yeah, big time. You just have to look at them and you have to be ready to pull the trigger. And that's why you have to come to guys like us to help us prepare your portfolio and your standing for that.
Yeah, knowing where you stand with your mortgage. That's just one. I don't know how much I owe. They ballpark it, but I won't lie. There's a lot of clients when you ask them, "Hey, what's your interest rate?" They're like, "I gotta look." Yeah,
like you should know your interest rate. That's probably. I'm not saying it always is. That's probably your biggest asset is your house. Well, your biggest asset's yourself. We'll go there.
Invest in yourself.
Yeah. But your biggest financial obligation and asset's usually your house. You should know everything about it. You should know what your heating bill is. You should know what your property tax is. You should know what interest you're paying. You should know that if you add your property tax to your mortgage bill, how that affects the interest. There's so much that needs to be talked about, and you just need to listen. You need to learn. And
you can't shy away from borrowing money. I come from, my parents have always been, debt's the enemy, enemy. Pay down the mortgage. Under the
mattress, Italians.
Pay down the mortgage as fast as you can. When you're like, okay, well, somebody might come they have a $500,000 mortgage. They come into some money. They're like, I have $200,000. I'm going to put it all towards my mortgage. We're like, well, no, if you actually invest that money, you might actually be able to make more than the interest you're paying. And they need to see that on paper. They need to see it drawn up, showing people how they go through with it, because is that fear of, there's nothing wrong with paying down your mortgage. It's a safe bet,
yep.
But you're also leaving some money on the table potentially. Like, why not make more? Another thing, before we wrap this up, I think to talk about borrowing money to invest.
Yep. Leveraged investing. So I have everybody's doing it.
Yeah, just do it. Borrow money. So borrowing money to invest. Investment loans are very common now.
Yep.
Essentially,
were extremely common in 2020 when interest rates dropped heavily.
Yeah. So, Dante, you have a job and your credit is really good, and your TDSR that we just discussed is relatively low. So hypothetically, you can go to a lender and say, "Hey, I want to borrow $100,000 to invest." You can borrow that money, open up a savings account, put it in that non-registered savings account. So now you have a savings account, and you borrowed money. So what are you responsible for paying? The interest on that.
Yeah.
But when you buy real estate or invest in a non-registered savings account, that interest becomes deductible. So what that means is that interest you're paying is coming off of your income.
Yeah, which is such a much bigger factor than people ever think about. Because let's say, and we're going to use you, Dante. Let's say you want to invest $500 a month. Like, that's in your mind. You're like, I'm going to start investing $500 a month. So in a year, I'm going to have $6,000 plus whatever I made. Yeah. You could also borrow $100,000, assuming it fits in the budget. You borrow $100,000. Your interest payments are $500 a month. So the same going out as what you were ready to do, except now you have compound interest on $100,000 instead of $500 per month. And the kicker is, if you're paying, let's assume it is that $6,000 in interest, and your tax rate's 30%, you get to write off 30% of that interest against your income. So that 500 is not 500. That's 350.
Yep.
That's a really powerful tool. Again, talk to a professional first. Make sure it fits within the budget. Make sure you can get approved properly. Make sure you're not already right here with all your debt. But it is an extremely powerful tool if it's invested properly. Just understand that high highs and low lows with leverage investing. So when you do really well, you're making much more because you've used borrow money. But when you're doing poorly, you're actually losing much more. So you have to just understand exactly what your tolerance is.
Yeah. It just comes down to knowing the risks involved too.
Yeah.
Everybody wants to borrow money to invest. You know, I go to the casino, lend me $1,000.
Yeah.
It's better if it's his money than my money, right? Yeah, marker.
You still have to pay back the marker.
Yeah. That's funny. But yeah, I think we spoke on interests. Interesting.
Yeah, we had some interesting nonsense today.
Yeah, do you have any questions on interest?
No, but I think it's great information. So give me more stuff to think about.
Yeah.
Just what we all need, more stuff to think about these days.
Yeah. Well, let's just go to the, this is ChatGPT here. This is a commonplace in the world today. What do you think will happen with interest rates this year? Again, this is ChatGPT. This is not
Robots are always right.
professional advice. This is coming from the robots. Right now, the Bank of Canada policy rate is 2.25% after being held steady in recent meetings. So, come on, make it easy for me. The bank will mainly be... I know that. This didn't even answer my question.
And
you know
this
what?
is why you come to financial advisors and don't go straight to ChatGPT.
Exactly.
You're just labeling it for us.
I know. Most likely, my expectation, not mine, the robots, is rates stay unchanged for the rest of the year. Second most likely, one small 0.25% cut.
Very unlikely.
Least likely, a rate hike.
Yeah. Things not changing is the most realistic right now.
Yep.
Least likely is a rate hike, sure. But if Ronald McDonald down south decides to do some more stuff around the world and causes more supply chain squeezes, inflation's going to go up. We haven't even realized the inflation of what's happened with oil yet. I don't think anyone really understands. It's like a 3-month delay. So there's always a risk. You need to be prepared when you're talking about interest rates that your interest rate may not be the same the next year.
But Donald Trump could just make a call when they go up. I don't like that.
Take the red card away. It wasn't a foul.
Yeah. I said FIFA. We don't like that red card.
We don't like that red card.
All right, sweet. Yeah, sweet. Interest. Like and subscribe. Follow us at Volpe Financial Solutions on Instagram. The episodes will be on YouTube soon.
Spotify,
Apple. Yes. Follow us. DM us with questions, things you want to hear us talk about.
Throw some curveballs at us.
Throw some curveballs. Yeah. We can go outside. No, I'm not even going to say that because compliance listens.
Yeah, they really do. Thanks, everyone. Ciao.
Bye.